My name is Peter Davis. I run an education software firm. We have our own trading platform. Customers are a mix of retail traders, professional traders, and the actual professional firms they work for. Tools are used both on the trading floors of professional firms, as you can see here on the trading floor of a London prop firm, and also in the classroom at professional firms as new traders take their first steps into trading, and that's new professional traders. So these successful traders I work with, they all have one thing in common, and that is they use fairly simple tools and techniques to decide when to get in and out of the market. Tools that tell them basically what other traders are doing right now. Okay. Now the other thing they know is they also know that the market doesn't offer the same opportunity every day. So think of it like this. Let's say you trade US markets and you get a day and there's big news coming in about Brexit. The news is that Brexit is finally sorted out, which would be nice, and that Europe has no restrictions on UK trading with the US, and at the same time a UK-US bilateral trade agreement is released. So let's say that happened in the morning. That's going to cause a lot of repositioning in the markets. It's going to be in UK and US equities, it's going to be currency markets, potentially interest rates, golds. There'll be a lot of new money coming into the market, but there's also going to be money moving from one instrument to the next. So people that have been short FTSE and short the sterling are going to get out of that position. And you've all seen this happen. Big moves following news, and those big moves following moves mean there's more people in the market, there's more money coming into the market, and more moves for us to piggyback and make money as traders. Now, if you take another day, the opposite of that, let's consider the day before the FOMC minutes, which is once a month. So on those days, usually everybody's waiting to see what the Fed's going to do. So large firms are not really engaged with the markets to the same extent. It's generally really quiet. And all that's left really in that case is people like you and people like me and people at these firms basically all trying to make money off each other. And it makes the day really, really difficult because there's not that big activity to piggyback. And as one trader now put it really succinctly, we were talking about Australian prop firms that had a lot of struggles because this happened in their market, new money wasn't going in there. And the way he put it was, nobody told the seagulls there was only one French fry in the parking lot. So think about it. If there's just short-term traders trying to make short-term money, they're literally just going to be doing nothing more than bouncing the market off each other and really going nowhere. And those are just two extremes. You know, on the first extreme, some of the traders that I know personally that use our tools are booking profits in excess of $100,000 a day. Now, these are prop traders. They can trade thousands of contracts. They're very well funded. One trader I know recently broke his firm's record with a day just over $700,000. And that's not made up. It's real professional traders with an understanding of the mechanics of price movement, and also that all days are not equal and that returns tend to be a bit lumpy. Right, you're not going to get the same amount of money every day, and that's real trading. Traders benefit from activity. It doesn't need to be an extreme of activity, but you do need some decent sized players in the market. Now, if you look at the trading screens of most retail traders, they generally look like spaghetti. You see lots of screens, lots of charts, often many charts for just one instrument. You know, people say, well, I've got to look at the daily chart, the 60-minute, the 30-minute, the 15-minute, and you get, like, you know, this multi-time BRAM analysis, and you might be using one or two screens just for one instrument, and sometimes there's so many indicators on those screens you can't even see the price. So this is me here at the desk of a professional trader in London. If you take a look at the screens, obviously this one's off here, top left. The bottom left is just showing the news. Same on the right side, you've got Bloomberg Terminal and Reuters on the right hand side. So again, that's just really news, market information. Top two in the middle, that's as many charts as this trader uses, right? This is a trader that can book $100,000 and that's all of the charts he uses, just long-term short charts to give himself a bit of context. The main focus here, if you look in the middle, is the price ladder. In fact, this trader is actually looking at 22 different markets. So you have your ladder, you have your trader at home with 6 screens of footprint charts, market profiles, indicators, and totally unable to make money on a handful of markets. And then you've got professionals like this cleaning up with a single price ladder for each market. They're not going to be trading all of the markets at the same time. They're going to be trading probably most 1 or 2, but they can keep their eye on 22 markets at the same time, waiting for the one that's actually got money coming into it and is presenting an opportunity, right? Because price charts, basically, what a price chart shows you, it always shows you what happened, okay? It shows you the result of trading. The price ladder gives you a better insight into what other traders are doing right now. And at the end of the day, no matter how complex you try and make trading with all of the indicators and all of the different time frames and all of that, there's one simple fact remains. Markets can go up and they can go down, and that is it. Doesn't mean trading's easy, because you wouldn't be here if you thought it was, right? And there's 1,000,001 ways you can get in your own way and self-sabotage as your results as a trader. But the markets, literally, they just go up and down. And today, we'll look at the way that professional day trading firms stay on the right side of that, often enough to be consistently profitable. So, first thing we're going to do is we're going to examine the mechanics of all price movement in the market, right? So if you think about it, your market, if the current price for your market is currently standing at 3,100, that market's not going to be 2,000 points in 5 minutes time. It doesn't go 3,000, 2,000, 2,050, 100, 4,000. The markets don't move up and down like that. They move in steps, okay? So, and there's a reason for that, and the reason for that is liquidity. So liquidity is the key to why price moves, or rather the consumption of liquidity. Now, when you say liquidity, people they tend to get it confused with volatility. So liquidity is the opposite of volatility. So more liquidity means less volatility, and vice versa. And liquidity is known as the availability of the other side to trade with. So if you want to buy, you need a seller to sell to you, right? The market itself does not sell you shares and contracts, right? All the market does is matches buyers with sellers. So when you trade, you're either providing or taking liquidity depending on your order type. If you buy at market, then you're going to be taking liquidity. You're going to be buying from a liquidity provider on the sell side, sell limit orders. If you sell at market, you sell to a liquidity provider on the buy side. Excuse me, I'm just making sure I've got the questions up. Okay. So liquidity is limit orders, it's bids and offers, and for some of you, it's already your eyes starting to glaze over as I use the trading terminology to tell you how it works. So what we're going to do is we're not going to do that. We're going to talk about floors and ceilings, right? We all know what a floor is and we all know what a ceiling is, I presume, right? So what we've got here is we've got a building. It's been designed by me, and I forgot to put in the stairs and the elevator. So let's imagine this is the market, right? So now where we are, we're on the top floor. And because we're on the top floor, we've got a ceiling above us and we've got a floor below us, because that's how buildings work. To move down to the next floor, what is it we need to do? We need to break through this floor right below us right now. And the market does exactly the same thing. The floors and ceilings are the limit orders. And those limit orders need to be consumed or eaten by market orders before we can break through the next level. So to move down, we've got to eat through or break through the floor, and to move up, we need to eat through or break through the ceiling. So let's click move through the first floor. So let's say we've eaten the liquidity below us, and now we've dropped down to the next price below. At this point, we've eaten through the floor. So some market orders have eaten the buy limit orders and we've dropped down. So at this point, anyone want to guess, is it easier for us to move up or down? Do you want to just type in up or down? Just have a guess. If I can see the chat. Up, yes, absolutely, Stephen. And the reason it's easier to move up, okay, is because the ceiling above us has a hole in it, right? There is nothing to eat above us and there is something to eat below. This is a really, really important concept that you've got to remember as you're trading, right? Okay, now move on. Next thing, ceiling has been repaired, okay, and we'll talk about this repair process in a second. So right now, as the ceiling's been repaired, it's no longer easier to go one way or the other, right? And it just happens the same way, all the way down. We eat the floor, we repair the ceiling, right? Okay, does that make sense? I think that makes sense, right? Now, what does that really look like? What does that really look like? Hi, Steve. Right, what does that really look like? Right, we've got bids here. This is the market. These are the bids. So these are the floors below us, known as bids. These are the offers above us, and also the ceiling, right? So the important thing to know is when you're looking at this model, the floors below you and ceilings above you, in the market on the buy side, when you're looking at the floors, there are no floors above you, right? There is no buyout liquidity above you in the market. So there's 10 levels of depth here, but actually that's just a limitation of the data feed. There's actually lots and lots and lots of depth right below, probably hundreds of prices down, but there is none above, right? And on the sell side, same thing, right? We can see maybe 10 levels of ceilings here or offers. There's loads more above, but there is no limit orders at any of the prices below us. And this is important. And the reason it's important is that as you move through the market, as you move upwards, you're moving into areas where liquidity does not exist, right? So what happens as you move up, in this case, you're going to move up to 23 to 22.70, what will happen is it will take time for the floors below us to be repaired, right? And in a fast-moving market, what that the kind of the effect of that is in a fast-moving market, you tend to get these vacuums behind you. So if the market pushes up really quickly, you get this vacuum below you where the floors haven't actually built up enough to support the market. So that's why quite often when the market moves up really quickly, it tends to fall back. It's a sign of weakness, right? When the market moves up really quickly, you don't get that liquidity, the floors building up beneath you as quickly, and so price can drop back very easily. A lot of pullbacks are just down to a relative lack of liquidity in the market below you. Okay, so just remember the floors and ceilings, but also remember there is no floor above you, right? So as you move up, there's nothing supporting that move up. It's also the reason where if you tend to get days where it really churns, the market churns slowly and it's a slow plod up and it never seems to pull back. It's because that slow plodding move up does have time for those floors to build below us. And spotting and understanding that and being able to spot these liquidity vacuums where price pulls back because of a lack of liquidity and not because of counter trend trading is quite a big opportunity in the market. It's one of the ways you get to trade pullbacks and benefit from order flow. Anyway, so here it is in all its glory and in action, which is the depth of market. It's also known as the DOM, also known as the price ladder, and in this case it's known as depth and sales because this is Jigsaw's take on the traditional price ladder or DOM. Now, at this point, whenever you show a new trader this, they usually go, oh my God, look at all the numbers, they're horrified. And they say, you know, can't you just give me flashing green and red light to buy and sell? And hopefully by now, most of you are savvy enough to know that buying those kind of red light, green light magic systems just doesn't tend to work out. But the good news is, this is not about reading or remembering all the numbers. It's about the way it moves and looking for outliers or sudden halts in movement or obvious signs that new money is coming into the market. So let me just walk you through a couple of things. So in this image here, we're in an overall move down. So we can see that price has been here 23.58.75. We've gone all the way down to 23.52.75, and now the market's moving back up. So what is it you're asking yourself? You're watching this market. What is it you're asking yourself? You're asking yourself, is this a reversal or is it a pullback? Because if you know it's not a reversal, you can make money off a pullback trade, nice trades, good trade locations where there's usually not a lot of market manipulation because there's not that much, not that many people getting into new trades to knock around. So we're going to move down and we've just moved up. So what do we want to see as we move up? Well, what we look at is we look at these numbers here. So this is the number of contracts it takes to move up through a price, right? So we traded 45 contracts. We had 45 buy orders and then we ate through the ceiling. We had 87 buy orders and then we ate through the ceiling. We had 68 buy orders and then we ate through the ceiling. So that gives us like an idea of how much real liquidity is there. And I say real liquidity because if you look at the numbers here, these are always way bigger than you actually trade. So you might see 200 but trade 20, right? So this number here, that tells you what did they actually do? You know, what position did people actually get into? Then if we look here, we see these 320, right? And that's what I mean by looking for an outlier, looking for something obvious that you can see, that you can say, well, that's different. And this 320 here is indeed different. And what has happened is that we've gone up there and we found that the reality at that price is the ceiling was a lot thicker. We traded 320 contracts, much more than we traded any other price. We traded more because the liquidity, the limit orders, the ceiling, they absorbed the buying, right? Then we saw, as we're ticking down, we can see the size now has switched to the sell side. We're now selling off. So we had these 320 traders. Looks like basically people kept buying, got trapped. These couple of prices here, as we traded some quite big volume there, that's a sign generally that people, the guys who are buying here have just bailed out. You know, we don't know. We never know, okay, this was somebody entering or exiting a trade. We have to make assumptions. We don't know their long-term or short-term, but we can say there is certainly a big enough percentage of short-term players at any one point to have a good idea that there's people trapped here. And now that we can see a bit of signs of a bailout, we can now see that this market has basically rolled over. We switched to the sell side, quite a lot of size, because basically what's happened now is people have seen this 320 trapped. As the market starts to tick down, they get out. But also you see other sellers come in to kind of initiate new short positions because they think the pullback's done. Okay, so this is typically the way a pullback works. So that's a reversal. A kind of reversal is a pullback. This here, 320 contracts, where we see a lot more size trade at one price or one or two prices and market not go anywhere. That we call absorption. And that's just one order flow event. One that in this case, we look to play a pullback in a short trade. Now, let's say the pullback didn't work. Let's say, okay, I got short here. Where's my stop? Well, my stop, 56 to be safe, right? Because you can kind of break momentarily one of these prices. But basically, if that really was buyers getting trapped and the market's now rolling over, on this particular market, put a stop at 56 and you've got a great risk reward. And if you can play a risk reward game more than a win rate game in trading, you're in a much better position. It just allows you to have runs of losers without actually decimating your account. So we always look to play a risk reward game and not a win rate game with order flow. Now, there's a lot of other order flow events you can look out for. You can look out for momentum. You can look out for value disparity across markets, which is basically when you've got correlated markets and some of them have order flow but didn't come into your market yet, so you know it's about to come. The scalping opportunities, there's pulling and stacking events. There's a whole lot, and obviously I can't show you all of them today. Now, you look at the numbers like that, yeah, it is a very numeric thing, but it is just about movement, right, and looking for outliers. And you know what? If you can't spot it as an outlier, it's not an outlier, right? So, you know, if it's like 60 traded at one price and then 65 at the next price, that 65 is not an outlier. 60 at one price and 500 at one price, that's an outlier, right? So we're looking for big obvious things. Now, for those of you that are more visually oriented, this is called Jig Swaps in Vista on the left here, this chart. And we've got some depth and trade meters over here on the right, which we just use at specific times. So what we can see here, we can see a market that was basically, it was in a bit of a trading range, right? And then what happened, very, very typical thing, the market broke a few ticks to the upside. But then you see this circle here. So what the circle shows, it's showing us where an abnormal amount of trade occurred in a very small range. And in this case, it's just at one price. It's mostly blue. That means that it was mostly buying at that price. And when you see mostly buying and it not moving, it means the seller liquidity, the ceilings are just getting thicker and thicker, and or they're just too thick to break. Usually they're not too thick to break when you get close. In this case, they were. Quite often they'll just add some contracts as you get there. But the seller liquidity absorbed the buying, and we did kind of tick up a little bit, but then the buyers basically were trapped. Buyers carried on buying, price stopped moving, and to the left we can actually see the high liquidity that was there all along. So you can see this high liquidity area. So this is showing you the ceiling in this case, and you can see, because the ceiling's a lot lighter, that means the ceiling was a lot thicker at that price, and that was effectively, you know, market got up there, they got the buyers got trapped, and then we can see what happened. Market took a dive. Now on the far right, some other things we can see, because we don't just look for the absorption, we do look at things like what's the balance of trade. So if you get into a trade and you know, you're in an S&P trade, you'd really expect, a decent amount of trade to be coming in, and you'd want some kind of an imbalance. Now I typically look for 1.5 to 2 times sellers to buyers on the way down. What we can see here, we've got an imbalance meter. We got almost 5,000 sells, and this was actually reset as we rolled over. We got 5,000 sells, 3,800 buy market orders. So we have market moving down, and we also have more sellers than buyers. We've got price progression down. That's what we like to see overall. Now, one more thing to point out, right? Outliers. Do we see any outliers as we move down? Do we see any outliers? Yeah, we see 286 and 238 here, and we can see that was as far as we got. Okay, so we can see the kind of numbers on the way down. Then we got, we had a 55, 11, and 1, and then this 286 and 238. We see that's as far as we've got. Right now, it's moved back up. What do we see? Well, one interesting thing we can see here, these 280 contracts. That's the number of contracts that have been added to the ceiling since we've been trading here. So if you look across here, we're only showing a ceiling thickness or limit orders of 59, right? And so what will often happen, you'll see 59, and then you'll see 100 trade, and you'll still see 59, and another 100 trade, you still see 59, and 300 trade, we still see 59. The reason we're seeing that number there is because they've added 280 contracts. So we know that we've kind of stopped here, we've moved up, we've now traded 306 contracts at that price, we've added 280 contracts since we've been here to the limit orders, to the sell side. So we know some sneaky seller is actually adding limit orders as buyers buy at that price. Okay, so we consider again this small move up is a pullback, and a good chance a move down will continue from here. We like to trade in the direction of the trend, so we like these little moves, these little pullbacks. And if you're right, where are you going to get to? On the last push down we got to here, you'd expect to get to there. You'd expect to get, further through there. If you're wrong, where do you need to put your stop? Okay, 2 or 3 ticks above this area here, right? So that's what order flow is about. It's about using real actionable information about who's trading, who's stuck, and how can I get a good risk reward. So this is sort of rich information about who's doing what that professional traders really use, right? Really use every day, right? Now, reason order flow traders are successful is mostly one of having a certain perspective, right? So mature traders know that the most important consideration in the markets, doesn't matter whether you trade order flow, doesn't matter why you trade, but it's basically about cause and effect, right? So traders look for causes. In a case of order flow, a cause might be like trapped traders. And those trapped traders that have an effect, they get out of the market, they have a stop run. You see a lot of long-term investors, they'll look at short ratios to see how many people are short to wait for a short squeeze, right? So that is looking for a cause. A short ratio is a cause of potentially people getting in the stop run. So the causes are generally small in terms of being able to have a good boundary where I can say, I can see that cause at this price. I know I'm wrong, you know, within a fairly small range, but the effects are large, right? So, you know, I'd say that the cause, the loss on the cause or the downside on the cause is usually, you know, a 1, and the effects of the cause are, you know, anywhere from a 3 to a 10. That's the kind of ratios we're looking at. So like when trades are trapped, you can see the precise location they're trapped, the exact prices. When they stop out, you get an extended move. And if that stop out's already in the direction of the trend because they're getting stuck in a pullback, you're generally going to get to be able to ride a bit of a trend as well. So you get small, precise stops, larger relative targets. Good risk reward on your trades. Now, your stops are going to be relative to how volatile your market is as well. So, you know, on US Treasuries, you can have 1 or 2 tick stops often. On crude, it might be a lot more, it might be 7 or 8 ticks. Now, if you combine cause and effect with a price level you're looking at, like a double bottom, for instance, order flow part helps you identify the trigger of the move. It doesn't do it every time, not on every reversal, but on a large percentage of them. So if you're trading something like a breakout, an opening range break, a double bottom, something like that, then order flow is what's going to help you actually confirm that trade, or just not take it completely. In addition, order flow gives you a lot of things we call second entries. So quite often you're going to have your eye on one price point, and then, you know, maybe it comes to your price point, moves away without you, and you think you've missed out because you didn't catch a trade. With order flow, you actually have multiple chances to join a move because of the way these sit. You know, let's say a move up, the way the floor's built behind you, it actually builds up multiple prices to lean on as price progresses. So you're actually going to see within a single trend, you'll actually see lots of different entry points within that trend that are quite safe to take. So you don't get this idea that you're always waiting to hit the bottom, take a trade, and then wait for the top. You know, there's lots more opportunities. And also, it's not just about getting into the market. So analyzing the flow of trade once you're in a position is actually the simplest use of order flow, right? So the reason is that if you think about it, the complexity, in fact, it's probably stating the obvious, right? But the complexity of a market turning around from an order flow perspective is higher than the market going in one direction, right? So a market's got to move down, it's got to see the absorption or whatever order flow event is, and then you've got to see traders coming on the other side to start moving it up. And that's the sequence of events. There's also something else in order flow we call momentum, right? Momentum is just the ability to read when the market's got really good flow and it's unstoppable. And we use that to reject entries, get a better trade price. So if you've got momentum against you and you want to go long, you wait till the momentum's finished, right? You get a better price because it'll have moved down further. And use it to manage your trade, because if the momentum dies out in your trade, maybe it's not going to work out. Or if the momentum never comes in on your trade, maybe it's just not going to work out. You get into trade 5 minutes later, there's no momentum, you probably want to think about getting out. Now, in addition, sorry, I would talk about the secondaries. And the other thing about order flow, over time, it'll stop you from trading against the market, which is one of the biggest mistakes most retail traders are making. Because a lot of retail traders are all about support and resistance. How does the market hit support? By moving down. So basically, we trade support and resistance traditionally. There are better ways to trade it, but traditional support and resistance trading will have you buying when the market's moving down. It will have you selling when the market's moving up, which again is the opposite to what professionals do. Now, how do you learn this? When in a professional firm, what they like to do is they like to take on new traders with zero trading experience. So a lot of times they take guys from university, to smart guys, quite often people with sporting experience, and they'll put them on a program which is about 25% theory and 75% hands-on practical experience, and that's living and breathing the order flow, because this is something that moves, so you have to experience it yourself. And it's a bit like learning to drive, right? You could learn all the theory about driving, study it for months or years, but you'd still not be able to drive a car. For that, you need to experience it to learn by doing. And we do the same thing. So with Jigsaw, we give everyone 10 hours of trading videos and a set of instruction on which way to approach those videos. But one of the first things we tell you to do is forget the theory for a minute and do the drills that we set. So we give you from the drills, so you go from having like concepts like absorption and momentum, which if you've never seen them play out, are just kind of completely abstract to you right now. You get to go from those concepts to actually seeing them and experiencing them. And then as you go through the other training material, it actually all starts to make a lot of sense. We talk about absorption, you've already seen it. Now, of course, we don't force anyone to do drills, and there's people that don't get anywhere with it because they don't do the drills. And the drill side, it takes generally a couple of weeks, not a couple of weeks full time. We recommend 1 to 2 hours a day. So you can do a 60 to 90 minute session once or twice a day. After that, you should just turn it off, because you don't learn by cramming, right? Now, at the end of 2 weeks, you're going to know if order flow is for you. And if it isn't with Jigsaw, we just say, okay, well, if it's not for you, we'll give you your money back. But generally speaking, about 95% of the people that do the drills will keep the tools because they get to that aha moment. Now, there are some pitfalls to this, right? Most common pitfall with order flow is not starting in the first place. A lot of people look at it and just decide it's difficult and say, well, I'm going to look at something simpler. I can't tell you how many emails I get that say, I'm looking for something simpler. And it's interesting because at a professional trading firm, they take people that never traded before and they pay those people and teach them, and they pay for their training. And they want to return on their money as quickly as possible, and they want their traders making as much money as possible. So if an easier way existed, they'd just use it, right? It's as simple as that. It's all about the Benjamins. So industry consensus is that this actually is the easiest and fastest way, but there's lots of people out there selling you guaranteed success without you having to switch on a brain cell. And obviously, if you're still at that stage in your trading, that's fine. Once you've got through it, come back, look at order flow. We get a lot of people that say I'm more visual, which is usually a short way of saying I want a red light, green light system. They're scared by the presence of numbers. But again, if the red light, green light system existed, right, there wouldn't be any prop traders. Prop firms would be using it. They wouldn't employ the traders. They'd just use the red light, green light system. They'd just get a monkey to press the right button at the right time. So bottom line is that reading the price ladder is completely visual. It's all about movement and nothing at all to do with mathematics. Then we have traders and they decided to adopt order flow because their 6 screens of charts and 500 indicators aren't helping them. They are unable to make a decision. And they know they overcomplicated it, right? So they say, right, Pete, I overcomplicated this. And we say, okay, we'll get you set up. And they get order flow and they think this is really good. And then they add something else and add something else. And basically, they do exactly the same thing with order flow that they did with the charts, right? So order flow has become a big fad since back in 2011, where there was an educator called John Grady, who's still really good. If you want to go and look up John Grady after this, he's a really great guy, really great educator. But around 2011, John Grady and Jigsaw basically were 2 of the pioneers really pushing order flow to the mainstream. And now you've got all sorts of new complex tools coming out every week with wacky terminology like stopping and continuation ratios that do nothing but baffle you with BS, but kind of give you the promise of like taking the thinking out of it for you. And it's just nerds developing complex tools that have got no real value except taking your money off you, okay? Now, other thing, overtrading, right? It's exciting to see traders get stuck and then see the market pop against them, but you really need to be selective. So what happens otherwise is you end up playing too short a game. So you end up playing this game, picking up pennies, and end up in a small trade when a larger opportunity comes along, right? So there's nothing worse than missing a big trade because you were so focused on the micro picture. So it's good you be selective, you focus on your order flow to get you the good entry, you let them, you focus on the order flow to let the market move your way a bit, and then you let the thing run. Right, you don't just keep taking little trades. Yeah, a lot of people are scared to let their trades run. Now, somewhat related to that is the fact that, as we discussed earlier, the days where more money is coming into the market are the days where there's more opportunity. And as a trader, you do not want to be making, let's say it's $1,000 a day on all days. If you're making $1,000 a day on an average day, and then that's great. But if you still make $100,000 a day when a Trump tweet drives the S&P up 200 points, you're not making the most of the opportunity available. There's a bit of order flow that you're not really considering, and that order flow should be relaying to you the amount of participation on that day. Other mistake, final mistake, is starting from scratch. In fact, this is a common pattern for traders with no way to measure their progress. If you already have a fairly decent way to assess the big picture, keep it. If you have a breakout trade that's fairly reliable, use the order flow to improve it. Don't just say, oh, order flow is good, I'm going to take away everything else I've ever done. So improve with the order flow, better prices, more confidence on knowing when it's working out or not. As long as you aren't the 500 indicator guy, or you're trading moon phases, then adapt order flow gradually to what you do now, presuming that's got some merit. If in doubt, if you're doing something now, you're not sure it's got merit, you can always give me a Skype. My Skype ID is Jigsaw Trading, all one word. I'm quite happy to have a free chat with anyone about what you do now and how to approach improving it. And that last pitfall, basically, of always changing stuff, always starting again, applies to 99% of retail traders and 0% of professionals. So if you don't have a way to track your progress, right, you'll never know what's working and what isn't. So when you pick up order flow at first, what you're going to see is your progress is going to come very quickly. It's a new skill, so you're going to be like leaps and leaps and leaps. You're going to watch it on one day, and it's going to be you're going to have a sweaty forehead, and you'll go, wow, that was intense. And the second day, you'll see all the stuff that you didn't see on the first day. You just come in leaps and bounds. As you refine it and you start trading with more size, you want to focus your efforts on the most rewarding setups and behaviors and the things that you can see best. You'll also want to work on specific issues like closing trades too early, which is why we have this, and it's called Journalytics. It's the most advanced trading journaling and analytics system anywhere. It's even got real-time news feed and economic news release warnings to better equip you to know when a market-changing event is coming. And we built this, but no other platform provider built it. There's a reason we built it, nobody else did. We built it for professional firms to use, and professional trading firms do use this. They use it very heavily with their new traders, and it's mostly because we understand the trader development process, that it takes a number of things to really develop as a trader, right? Order flow is one of those things, education is one of those things, feedback from the markets and feedback from your own performance is another important things. Now, of course, a lot of vendors won't tell you this. They'll tell you just you only need this single magic bullet that makes you profitable tomorrow, okay? And what you'll also notice about a lot of those vendors is they don't tend to have a relationship with brokerages or proprietary trading firms. If they did, they'd have to be compliant with CFTC regulations, which would actually forbid them from making the claims they do. So it does take a bit of effort to make money as a trader. There's absolutely no doubt about that. If somebody's trying to take the work out of it for you, they're lying to you. This is what professionals do, and if there was some magic service to make them profitable tomorrow, they would absolutely use it, but there isn't. So for the professionals, it's about 4 weeks in the classroom, the rest is hands-on until they're profitable. Now, another thing we do at Jigsaw, because you're not sitting there with a bunch of professional traders, we have a live chat room, so you can actually talk to other people that use the tools as well. Now, what does this cost? We have an independent package for $579. It gives you the platform for life, the analytics, the chat room, both for life, and it gives you 10 hours of the best order flow education you can get anywhere. We also have a professional version, which is $879, which gives you another 7 hours of advanced education, and that stuff you will keep coming back to for years. Stuff on scalping, trade management, market open setups, a lot of real examples. And that's $879. Now, what we're going to do today, just for you, this is for life, remember. We're going to give you the professional version for just another $99 on top of the price of the independent. It is worth getting the professional version. There is a lot of education in there that's additional that really will help. I think the scalping video we've got in there has got about 6 individual trade setups. If you're interested, go to jigsawtrading.com/GoPro. If you want to get in touch with me, you can get in touch with me through the website. My Skype ID is Jigsaw Trading. Glad to hear somebody likes journalytics. One of the customers, Stephen, he bought the institutional package 10 days ago. Very happy with it. Great to hear. I'm not US based. I am from the UK. I live with my family in Thailand, and I'm currently 50 meters from the beach. Sure. So with that, I will hand back to Anna. Thank you all for listening. All the best with your trading. I hope you find what you need for it, and good luck.